So even futures contract, they don't move in dollars or cents. So they move in a minimum price movement called a tick, and it's set by the exchange and varies depending on the contract. So if you take the E-mini S&P 500 futures contract, its tick size is 1/4 of an index point. Okay, so you need 4 ticks in ES to have 1 point, which means that with the E-mini, $50 a point, each tick is worth $12.50. Now for something like the NYMEX WTI crude oil, the tick size is 1 cent per barrel. So it's different than ES. Since the contract covers 1,000 barrels, each tick move is worth $10. So you can see it in cents right now. So each time it does a tick up, or down, it's gonna be $10 with the E-mini version, the CL. But you can trade the micro version, which is MCL. It's gonna be 1/10 of that risk. So obviously, understanding tick sizes is important because it tells you how much money you gain or lose with the smallest price movement in a contract. Please always start with the micro version of a product to have a taste of the movements. Tick sizes are defined by the exchange and vary depending on the size of the financial instrument and requirements of the marketplace. Tick sizes are set to provide optimal liquidity and tight bid-ask spreads. That's also what I like about futures. Usually the spread will potentially stay the same for the whole day and will be quite tight. It's very, very nice. Even I trade mostly with market orders and I usually get a pretty good fill, okay? So much of a good fill that I don't feel I need a limit order to trade futures. The minimum price fluctuation for any CME group contract can be found on the product specification pages. Okay, I will show you websites that you can visit at the end of this presentation, and I also found a great futures calculator. So futures contracts are identified using compact codes that packed in a lot of information, and they look sometimes weird because they don't really make sense. So each code includes a product identifier like ES for E-mini S&P 500, followed by a letter for the expiration month and a number for the year. These codes originated on trading floors where speed and space mattered, and they've carried over into the electronic world we trade in today. You need to understand, I spoke with a pit trader. He has been trading for 40 years now. He was a pit trader for a very long time. And he started showing me the signs they were using to talk to each other. It is totally insane and beautiful. They had manual codes for letters, for months, for the options, buy a put or sell. Like I said, I'm not an expert, but I mean, they were talking a lot with their hands. And I don't know if you saw a picture of the S&P 500 pit, but it was so crowded that to make sure that we were talking to the right guy and trading with the right person, we had to have other signs. So guys were like pulling their ties up, like doing crazy hand signs to communicate with each other. So that's why these codes had to be very compact. I still don't know, and maybe Thor knows that, I still don't know why U is for September. Okay, I still have to look into that. But they made it very compact for that reason. They had to talk with their hands all the time. So you'll want to memorize the month letters, okay? H for March, M for June, U for September, and Z for December are the most commonly traded months for stock index futures. Also, when you trade futures, you need to be on the right contract, okay, to make sure that you are trading the contract that is traded right now. And also you want to make sure that when you're coming close to the expiration date, that you are still in the correct traded contract, okay? And you will see that with the volume. And you want to make sure that you settle your position before the contract expires. So if you see something like ESU5, you now know it's the September 2025 E-mini S&P contract. These general rules apply to the format of futures contract code, but it's important to be aware that codes and available expirations can vary across platforms, okay? You need to be aware of that. So a quick slide here about price limits and price bending, because we saw that, I think it was in early April, that NASDAQ flushed down like crazy a little bit before the close, and the market was halted. So as a trader, you want to know the market is fair and orderly. Exchanges like the CME Group use price limits and price bending to keep things in check. Price limits set how much a futures price can move in one day. It's measured in ticks. For example, equity index futures have a tiered limit system where prices can move down to 20%. But these limits prevent wild swings and allow markets to cool off if prices move too fast. Price bending works a bit differently. It dynamically adjusts the acceptable trading range around the last price and rejects orders that are way off, helping to avoid disorderly trades. So we are protected, guys. It's a good thing to know. Traders can still place orders beyond daily limits, but those orders only execute when prices return within allowed ranges. While price limits and bans make markets safer, hitting those limits has become less common in recent years. Still, knowing these rules is key to navigate the futures market confidently. Bonjour, Market Alchemist. Thank you so much for being here and watching this video. We've come to the end of this episode, but your journey doesn't stop here. Make sure to watch the next video in the series and don't forget to like and subscribe.